So actually, I'm going to start with thanking Anthony Kazakis and Julie Duquette for putting this together. This was actually a lot of work, as all the previous expos. Even I don't know if this is taking more work than live expos, but it's certainly a lot of effort, and it's really appreciated that we are able to display, talk about our industry, ourselves, and bring this information out to the folks who are interested. So we are the New York City Real Estate Expo, and this seminar is on the topic of insurance. So I'm going to share the screen. I think the screen is already shared. The first page is just my contact information. We're going to start with just a little overview of what we're going to talk about. So first, we're going to talk about a little bit about the First Fidelity Brokerage. That is the firm that I work for. Then we're going to discuss why rates are rising. Then we're going to discuss how to prepare for 2020 and how to mitigate future increases. I do have to provide a disclaimer that this webinar is being presented for information purposes only. We're not giving you any legal advice or any insurance advice or any other professional advice. For such advice, please do contact your brokers and your lawyers. But if you are interested in talking to us, we are obviously very glad to assist you if you would like for us to do so. Okay, so very quickly, FFB, which stands for First Fidelity Brokerage, was started in 1996 in New York City, and I took over as the CEO of the company in 2011. And in June of 2020, we became a member of PCF Insurance, which is a national broker. It is now the top 20th broker in the USA. We're probably going to be in the top 10 within the next few years based on our growth. We have 75 offices, 1,500 employees, and over 200,000 clients. FFB is a New York City office of PCF, and we specialize in 3 industries: real estate, construction, and education. They often, all 3 of them go hand in hand. Education is a little bit different, but the real estate and construction go hand in hand. And we have about $10 billion of values insured in New York City and surrounding areas alone. And the company, the broader company PCF, has over 100 billion of values insured. So there's quite a bit of expertise in insuring real estate. And I've been presenting at the Real Estate Expo since I think 2012. So this is one of my favorite things to do annually. What you'll see, one thing I just want to mention, as you go through my slides, you will see there are images of buildings. And I realize you may be watching this after the event has occurred, but if you recognize these buildings, if you recognize the name of the properties or the address of the properties or even where they're located, you'll see there's an image number. Just write that down and then send me an email. Send me an email, let me know, hey, I think this is X. And if you get it right, you will get a prize. Okay, so image 1 in front of you. Okay, image 2 in front of you. So FFB provides primarily 4 services. They're all related. It's risk advisory, risk management, insurance, and claim services. I am personally more involved in the risk transfer portion, which is the procurement and service of insurance, but my colleagues provide the risk advisory, risk management, claim services, all within our organization. Just a few words about myself. I've been involved with the insurance industry for about 25 years, absent the short stint of about 3 years where I worked for Western Bank as a banker. That didn't work out after 9/11, and then went back to insurance. Insurance has been a passion for me. I've authored numerous articles, wrote a publication, a book that we published on Amazon. But I don't know why it's also available for free to download right off the website. So if you're interested in learning the ins and outs of insurance, there's a kind of a guide 101. There's a book available for download. It's about a 2-hour read. Very, very exciting stuff. Okay, so let's get into this. Why rates are rising? So rates are rising essentially because of cyclical nature of insurance. So insurance goes in cycles. There's a soft market and there's a hard market. A soft market is where You're going to have lower insurance premiums, broader coverages, easier underwriting criteria, increased capacity, increased competition. And in a hard market, you're going to have higher insurance premiums, stringent underwriting criteria, reduced capacity, less competition among insurance carriers. And the factors that affect the markets, there's primary four factors. It's competition, it's underwriting profitability, it's investment income, and reinsurance costs. So when new capacity puts pressure on competition, as rates fall, so do underwriting profitability. Less profitable carriers enter the space, rates rise and attract new capital, which increase capacity. And goes again in cycles. More capacity comes in, premiums are reduced, carriers become less profitable, and they exit. More capacity, premiums increase with less competition. Okay, just a little bit about the claims, what's going on with claims and how they affect the effect in the hard market, soft market. So we've had several cycles throughout my career. The first cycle that I saw was in the 2001-2003 period. It was after 9/11. It softened to about and bottomed out to about 2012, and kind of started increasing to about 2018, and softened. And by softening, I mean the increases were not as great as before, and really hardened in the last 2 years. Looking at the combined ratios of carriers, and what that is how profitable these carriers, which is basically just the losses over the gains. In 2020, there was a combined ratio of 98.7, and what that means is a lot of carriers were below 100, a lot of carriers were above 100. So a lot of carriers that were above 100 lost money. Those who were below 100 made some money, but it looks like they only made 1.3%, which if you're an investor, that's not really good return for your capital. Triple I Milliman has predicted that for 2021 there's going to be combined ratios for the entire industry of 99.6. For 2022 is going to be 98.9, and for 2023 it's projected to be 99.3. And with claims such as Storm Uri, and Hurricane Ida, we already basically on par to beat the losses that were paid out on as an average for the last 10 years. There's actually a little chart over here if anybody's interested in seeing. It's provided by Statistica. They're showing what were the losses by type of natural disaster over the last 10 years. Next slide is just, I think this is good information. The largest event in the history of the United States has been Hurricane Katrina 2005. That cost the insurance industry $172 billion, followed by Hurricane Harvey in 2017. That cost the industry almost $134 billion. And Hurricane Maria, the same year, 2017, that cost the industry $96.3 billion. So these were enormous events. And if you look at two down, Hurricane Irma caused $53 billion worth of damage. So the insurance industry has been really beaten by losses. And if you go back to the slide, the weather related, you can see represents the yellow line. They represent a very large portion of the losses, but there are other losses that they are also have to contend with. Okay, so we're talking about New York City and New York State, and what are some of the specific issues that are affecting insurance in New York. One of the major issues that I think most of you have already come across is New York Labor Law 240, 241. Obviously, the 240, 241 just applies to the lines in the labor law book. And what that law basically says is the owner of a property has an obligation, a strict statutory obligation to provide a safe working environment to contractors and subcontractors and their employees. And this was a fantastic law for the first half a century. But when OSHA was formed, most states have done away with this law because OSHA had regulated safety. I think Illinois and Massachusetts hanged on until the 90s, early 2000s, and New York was the last state in the union that still has this archaic law. And what this law has been used, there's a whole cottage industry of claims and attorneys who specialize in New York labor law coverage, and that's because if a case is accepted as New York labor law, it's a guaranteed, pretty much a guaranteed win. And average settlement is in the $500,000 to $600,000 range, and if you go to trial, it goes into $2 to $3 million settlements. So the main issue with the New York labor law is that contractors who used to procure coverage that provided protection for the property owner or the landlord by indemnifying them and having their insurance include them as additional insured. Well, the problem has really evolved in the last 7 to 8 years, where a lot of the carriers who wrote construction insurance in New York have abandoned New York, and those who have stayed are either excluding coverage for labor law, they're adding limitations called hammer clause, where certain conditions have to be met, or they're charging an arm and a leg to provide this coverage. And the trend has been that larger contractors are buying up, they're procuring the proper coverages, but the smaller contractors are not. And it's very difficult to understand, to see whether the coverage is being provided, not by looking at certificate of insurance. You really have to know the carrier or have to read the policy, and that should be left up to your insurance consultant or insurance broker to review. So what's been happening, building owners have been hiring contractors to perform work, and those workers have been getting injured due to gravity, something falling on them, or they're falling off a ladder, or falling, really anything that has to do with gravity can be accepted as a New York labor law claim. And there's no, and they can collect the workers' compensation from their employer, but then they're going to bring a strict liability claim against the property owner. The property owner is then going to go back to the GC and the subcontractor and say, hey, we have a contract with you, indemnify us, insure us. And the contractor is going to say, well, I'm sorry, our insurance is declining because we don't have the coverage, which means that the real estate, the carrier that's providing coverage for the real estate is on the hook to pay that claim. So what a lot of the carriers real estate carriers have been doing is they've been adding labor law exclusion because they've been having a lot of these claims. And just to clarify, the law exempts single family and two family units, owners of those units from this law. So if you have a private house and you are not managing the construction, you are exempt from New York law. But if you are cooperative, if you are a condominium association, if you're a property owner, you're not exempt. Building owner, you're not exempt, and if you haven't seen these claims come in, they will come in. So we're going to talk about how to mitigate this in a few slides further down. But this has been one of the major obstacles for the insurance carriers in New York, and the cottage industry is so strong that it does not appear that this law is going to be amended. And all we want is to introduce comparative negligence, so we can introduce facts and see how guilty is the owner, and the owner will never be guilty. But then this will mean a lot of folks will stop earning their keep the way they have for the last decade or so. Many carriers have exited the space in New York. New York, just in general, has always been a very litigious venue. It has become more litigious over the recent years. Bronx in particular, a lot of carriers are really shying away from Bronx, and risks really have to be, really best of the best in order for some of the better carriers to offer terms. Carriers or underwriters are in a hard market. They're looking to underwrite the account more stringently. They want to have better submissions. They want to have more information. They want to have better life safety. They have, because they have so many submissions, they have the ability to pick and choose which accounts they want to quote on. There's more business they can handle. They run out of capacity. 9, 10 months into the year, and then just sit back and wait for the renewal. So everyone's cherry picking, which means that properties that are not Class A properties or Class A equivalent properties, they're getting left behind, and they're getting the breadth of the largest increases. Cyber market. You've probably heard of all these ransomware attacks and hacks throughout the world, and a lot of those were covered by insurance, and insurance carriers. It turns out that they were mispricing or underpricing the cyber liability insurance policies. So starting about May and June of this year, you begin to see pricing going up significantly, 20, 30, 40, 50%. A lot of clients are looking to buy more coverages. Their limits are being purchased at something called upside down, where the first 5 million limits are purchased are priced at, let's say, 5,000, and the next 5 million is priced at 40,000. And because they have contractual obligations, where they have to purchase that extra limits, it's a cost that was not budgeted and was not expected. And we'll talk about cyber market a little bit, I think, further down in the presentation. Property underwriters are concerned about a few things. They're very concerned about values being underreported. Historically, values were underreported essentially for one reason, because that gets you cheaper insurance, and as long as you don't have a co-insurance penalty, in any partial loss, you're going to get fully reimbursed. In a full loss, you'll just have not enough limit. The problem is you have something called translation. It's a term that I studied economics at NYU, but that term did not exist until recently. I heard it with one of our public officials discuss it, which basically just means temporary inflation. So we have our supply channel so we have supply channel issues that hopefully are going to be resolved in the near future, and inflation is going to come down back to normal 2%, 3% level, which I personally hope that's going to happen. Everybody does, but once wages start rising, it's going to be hard to go back. The other problem with the property is you still have models being revised. So the carriers rely on third-party analysts who model losses. One of the larger companies called RMS. They basically show the carriers, hey, if you have a hurricane here, if you have a fire here in this area, here's what you're going to expect in terms of losses. And the carriers they report to their reinsurance carriers, who don't want them to have concentration risk, because they're on the hook for any losses excess over the amounts that they maintain themselves. So even if you have a number of if you have an area with a lot of great buildings, the carriers may need to get off just because they have too much concentration based on these models, and then those big buildings will have to shop for coverage elsewhere, and now they're in the same shopping boat as everyone else, and they have to prove themselves to other underwriters, and it becomes it generally ends up in a hard market that you're going to pay more and get less. The last item is umbrella RPGs. So historically, umbrellas were purchased very, very inexpensively via risk purchasing groups. So you would have you have a homogeneous class of business that would be brought together in RPG, and they would have the purchasing power of the group, and they would buy you buy 100 million limits, or 200 million limits for 10,000, 20,000, 30,000, depending on the size of your portfolio or your property. With losses from New York labor law and new reinsurance guidelines for these carriers, many umbrellas for MPGs stop writing business in New York, and those who continue to write, they don't want to see any losses that are near the that would potentially exhaust the primary limit. And we've come into a situation where going back to the traditional market for regular umbrella, the pricing is so vast, it's an enormous sticker shock. So, for example, a company, let's say a complex that we have that used to pay $65,000 for a $10 million RPG, now they're being priced at $500,000 for a $5 million limit. So going from 60,000 to 500,000, it's an enormous sticker shock. And we're trying to figure out how to deal with that because there's the property manager involved, there's obviously lenders involved, etc. So overall, the prediction is going to be that the hard market is going to continue. It's going to continue well, I think, into to the end of next year, possibly into the following year. Let's talk about how to prepare for 2022. So you're going to be seeing restrictive terms and conditions. You're going to be likely seeing reduction in capacity. And if you get non-renewed by your admitted carrier, you may need to build the limits via multiple carriers. So you need to stack them or you need to quarter share them. And basically each carrier is going to want their piece of meat. So you're going to be just paying a lot more. So we're expecting, and what we're seeing, what we're expecting further down the line is for good loss history for good accounts, you expect 10 to 20% increase on the property. Accounts that have losses 20 to 100%, and if your account is non-renewed, it can be more than 100% increase. Also expect the deductibles to increase, particularly water damage deductibles. And before we used to be able to get $5,000, $10,000 deductibles. Now almost every carrier is insisting at $25,000, $50,000, $100,000, even $250,000, depending on the size of the complex. Liability, the major issues again we spoke about is the New York labor law. Limitations carriers are trying to add those limitations onto the policy or conditions for those policies. And I think most carriers, with the exception of a handful, have added communicable disease exclusions or COVID exclusions if they didn't have them on the policies before. Premiums are increasing generally 10 to 20% with good loss history and 15 to 25% with losses or more, depending on how severe your losses are. Umbrellas, again, we're going to be seeing non-renewals because of carriers are exiting, new life safety requirements. Some RPUs are going to say, hey, we need to have the full building sprinklered, etc. And if you are lucky enough to continue to be reinsured by an RPG, expect a 15 to 25% increase in premium. Cyber market, if you don't have multi-factor authentication and some other controls, there's a really good chance you won't even be able to get a quote, and you might have to bear this risk by yourself. One thing I quickly mentioned, we just put together or signed up to present a carrier, I think a program called Cyber Concierge or something like that, where it's a service where you call and you say, hey, we had an attack, and they basically do the whole crisis management for you. They get all the vendors involved, and all the vendors that are involved, they get them at a discount rate, the same rate, similar rates that the carriers would pay, and you have this person or team handle everything for you, but you have to pay everything out of pocket, and the cost for the service is actually very nominal. It's about $250 per company or essentially per company. Very inexpensive. And $250 if you have the selfie plate it's a no-brainer. If anyone's interested, please email me at epod@fibinsurance.com, epod@fibinsurance.com, and I'll put you in touch with the person who handles that. On the D&O side, on the private side, it's 10 to 20% increases. On the public side, the market is getting very tight. It's 30 to 50% increases that we're seeing. One good news is the workers' compensation. Because there are some new entrants to New York with very low LCM factors, there's potential to save on workers' comp. The workers' comp generally for real estate is not a big ticket item, but look, if you can save 10, 15, 20%, I suggest you do it. And historically, workers' comp has not been marketed. It's been in a group, safety group, or put in a traditional carrier, just renewed year after year. But I think this year, maybe ask your broker to take a look and see if they can save you even a little bit. Everything's going to help given all the other increases. And auto is increasing 7.5 to 15% without having bad losses rate. What can you do now? Meet with your insurance broker and consultant, do it like super early, have them give you projections for next year. Ask them for a copy of the submission that they shared last year and help them improve that submission. You know more about your business than they do. Help them present you in the best light possible. And you may want to discuss with another broker, for second opinion. I my kind of philosophy is, if you're with a large broker, talk to a mid-sized, smaller broker. If you're a small broker, talk to a larger broker. Larger brokers tend to have access, not have access to some of the programs or regional carriers, but while the small broker does not have the leverage that the large broker has with national carriers. So, if every few years have those conversations, it might end up you might end up saving or see a good amount of money and potentially improving risk management program. Marketing has become actually very complex. There's no single point entry system, and like in personal lines, the homeowner's auto, you can do single entry system, and it's going to display 20 quotes, 50 quotes. We don't have that on the middle market, true middle market, and larger accounts. So I just want to share with you what broker goes through. So if my team, we're in an account, we would go to a wholesaler. We choose 2 or 3 of the wholesalers. We would choose the markets we would go to. Then we would go to the program businesses that have specific programs that only they have access to. Then we go to the direct carriers, and this is just a sample. There's quite a bit more than what is being displayed here. But we have to talk to all these underwriters with all these folks, give them information they need, answer their questions. It's actually a pretty daunting job, and I guess I want to just quickly pat ourselves in the back for doing it, but and show you that this is we're actually providing a pretty excellent service. Okay, so what can you do for risk management for 2022? Get to know your losses and that of the industry. Only way you can mitigate them is if you know what they are. Review your loss history in detail. A lot of folks that I talk to in the C-level suites, they are familiar with some of the big lawsuits. They're not familiar with a lot of the small ones. And frequency is an issue for underwriters. When you have something occurring over and over again, they tend to believe that you have poor risk management. So, very, very important advice: go through your losses, see what those losses are, see what you can do to mitigate those losses. If a person keeps falling on a particular sidewalk, go fix that sidewalk. If you get the gist. So claims management is also very important. You have losses that are appearing in loss runs that could be handled better. Have your broker or consultant get involved and actually do a deep dive what your claims are and how to bring them down. Review your inspection reports and your responses. It's going to be very important, especially in the next year or two. Carriers are looking at that stuff. If they gave you recommendations and you didn't complete them, they're going to not renew you, or they're going to make it a condition that you complete those recommendations. With regards to electric fuses, many carriers already have a hard no to insure buildings with electric fuses, and some of the companies that have been doing it are now requiring that the buildings changed into circuit breakers. And if this was not in your budget for the next year or two to do, I suggest you revisit that, because at some point these carriers who are providing coverage for you will basically say, no, we will no longer insure you, and they may not be coverage available for you from anyone, or if it is, it's potentially going to be multiple what you're paying now. And the last but not least is update your contractor's procedures, and do not let contractors in without a signed agreement and approved insurance reviewed by your broker or vendor. I'm going to stress this just one more time. A lot of buildings let folks in with just a certificate and the basic purchase order. This has to stop. You're going, if you keep on doing that, you're going to face the consequences of having uninsured losses. So for the renewal, early submission to market. Generally brokers go to market 60 to 90 days, go 90 to 120 days. Request meetings with the key underwriters. If you haven't met your underwriter, meet him by Zoom. have a talk to them. Once they see you, once they talk to you, they're going to be more amenable to working with you. Personal relationship with an underwriter is very important. Strategy of negotiating with incumbents very early on. So we often do this where we talk to a carrier 60 days or 90 days in advance, and we outline a proposal that we will renew with you under these conditions. And if we come to terms, we don't market that account. Carriers don't want to. It really takes them a lot of custom. It costs them a lot of money and time to bring business on the books. They don't want to lose it because if you can negotiate with them early on to keep it out of the marketplace, everybody wins. Ask your broker to see if you can unbundle some of the coverages. Like one example is terrorism. So terrorism on the property side, some carriers have a 3% charge, some carriers have a 5% charge, some carriers have less, but the kind of 3 to 5% is the dominating. It's the most common percentage to charge for terrorism, but the terrorism is usually certified acts of terrorism, not even full domestic terrorism. Well, there's a whole cottage industry in London that can provide full terrorism with domestic terrorism at a fraction of the price. So you can unbundle and purchase that coverage separately. And there are many examples of those. You talk to your broker, they'll know what to do. Ask about two and 3 year deals. If we're expecting a hard market to continue for another 2-3 years, ask them for a 2-year deal, a 3-year deal. They're not popular as they were years ago, but carriers still do. Ask your representative for a multi-year deal. Consider much higher retentions. Again, you want to keep the frequency away. You want to keep it as low as possible. So ask if you have a $5,000 deductible, ask for $25,000 deductible. Try to retain the losses. And when you retain these losses, will force you to focus on mitigating these losses and actually be aware where these losses are coming from, which in the end is going to save you anyway. Consider captives if you're large enough. Captive is a great solution for retaining some of the risk and having maybe be insured by a third party for higher limits, excess limits. But you're not going to be trading dollars with the carrier, and you're saving on those administrative expenses that are being loaded onto a traditional insurance company. And one thing with captives I'd like to mention. There are still certain structures with an 831B captive that can provide a great tax incentive for owners. Just summarizing in a sentence, if your captive is paying under 2.2 million in premium and your losses are $1 million, you have 1.2 million left as surplus. Well, the 1.2 million can technically be distributed back to the owners, and under the 831B structures, that dividend goes to the owner, essentially federal tax free. Now, just a warning: this structure is on the dirty list of dozens by the IRS, so it's not a strategy for everyone. Definitely talk to a professional who's familiar with this, who can give you proper guidance. It can be done properly. We do it all the time, and we actually have a captive division. If you're interested in talking to us, we'd be happy to make the introduction and give you a proposal. And the last but not least is leverage with peers. If you have friends in the industry also on properties or somewhat homogeneous, you can move all the business to one broker and have that broker say, okay, instead of having one client, I have 5 clients who are now renew on this January 1st date. Let's look at them as a package, not individually. And underwriters, when they look at more premium, they'll consider it. Not everybody, of course, but they'll consider it. I think that brings us to the conclusion of my presentation. Again, my name is Eugene Podakshik. My contact information is here. It's epod@ffbinsurance.com, and my telephone number is 212-933-9050, extension 1801. And our corporate website is ffbinsurance.com. That's FFB, like First Fidelity Brokerage, ffbinsurance.com.
Thank you, Eugene. Very informative. Great firm to work with. I know that our firm, the NYC Real Estate Expo, does use Eugene for our umbrella when we do our events. So his staff is extremely very polite, very on top of their game, and very fast. And so once again, Eugene, thank you so much. Everybody, especially that's on live and also live streaming, they will get a copy. Eugene will get a copy of your email address. So he will be sending out a thank you note as well as a copy of his presentation. And if you have questions from here on in, send them in to Eugene. He'll be happy to help you guys. And again, a great firm to work with, a true pleasure to work with. Everybody take care. Thank you, Eugene. Bye-bye, everybody.
Bye, everyone.